The man who built a fortune on buying stocks now sits on more cash than most countries possess. Let that settle in your mind for a moment. Warren Buffett, the Oracle of Omaha, the greatest investor of our time, is holding hundreds of billions in cash and treasury bills while the world screams at him to buy something, anything. And here's what makes this so quietly profound. He isn't worried. He isn't panicking. He's simply waiting. And in that waiting, there lies a lesson so essential for anyone over 50 that it might just redefine how you think about your retirement years. Before we go any further, understand this clearly. Nothing you hear today is personal financial advice. This channel exists to share wisdom, perspective, and timeless principles, not to tell you what to do with your specific situation. Always consult with a qualified financial professional about your own retirement planning. What we're exploring here is philosophy, not prescription. We're looking at how one of history's greatest financial minds thinks about cash, safety, and the delicate balance between growth and preservation. Now, let's sit with a question that probably keeps you awake some nights. You've spent decades accumulating. You've saved through recessions and boom times. You've watched your accounts grow, shrink, and grow again. And now, somewhere past 50, maybe past 60, you're supposed to figure out the perfect allocation. 30% cash, someone says. No, 10%. No, keep it all invested because inflation will eat you alive. The noise is deafening. But what does Warren Buffett actually believe about cash in retirement? Not what the headlines say he believes. What does his actual behavior, his actual words, his actual life choices tell us about holding cash when the game has changed from accumulation to preservation? Here's the truth that nobody wants to say out loud. Warren Buffett doesn't manage money the way most retirees do, and he never will. He's not drawing down a portfolio. He's not worried about sequence of returns risk. He's not calculating safe withdrawal rates or wondering if his money will last another 30 years. And yet, the way he thinks about cash, the way he talks about waiting and patience and not doing stupid things might be more relevant to your retirement than any target date fund formula created by Wall Street. Let's start with what's actually happening right now. As of the most recent reports, Berkshire Hathaway is sitting on record levels of cash and short-term treasury bills. We're talking about a cash position so large it makes headlines every quarter. Financial journalists write breathless articles asking when Buffett will deploy this capital. Critics call him old-fashioned, out of touch, missing the boat on technology and innovation. The stock market keeps climbing, and there sits Warren Buffett, refusing to chase it. But here's what those critics miss. Warren Buffett isn't holding cash because he's scared. He's holding cash because nothing meets his standards. He's holding cash because at 94 years old, after more than 7 decades of studying markets and businesses and human behavior, he understands something fundamental about valuation and patience that most people will never grasp. He's holding cash because cash, right now, in this moment, is exactly where he wants to be. Now, does that mean you should have 30% of your retirement portfolio in cash? Not necessarily. Does it mean you should have 10% or 50% or any specific number? That's not the right question. The right question is this: what is cash actually for in your retirement years? And how does having it change the way you sleep at night? Warren Buffett has said many times in many different ways that cash is optionality. Cash is freedom. Cash is the ability to act when others cannot. But for retirees, cash is something even more essential. Cash is survival. Cash is the buffer between you and a forced sale at the worst possible moment. Cash is what lets you ignore the market's madness when everyone around you is panicking. Think about what happened in March 2020. The world shut down. Markets collapsed. If you were 70 years old with everything invested in stocks and you needed money to live, you had two terrible choices. Sell at catastrophic losses or skip your spending and hope things recovered quickly. But if you had 2 or 3 years of living expenses in cash, you didn't have to make that choice. You could simply wait. You could let the market do whatever crazy thing it was going to do while you drew from your cash reserves, calm and unbothered. This is what Buffett understands about cash that goes beyond investment returns. Cash isn't about optimizing every last percentage point of growth. Cash is about not being forced into bad decisions at bad times. And by the time you're 60, the margin for error is gone. You can't wait another decade for recovery. You can't earn back losses with more paychecks. The math has changed, and that means the role of cash has changed too. Let's go back to 1999, during the madness of the dot-com bubble. Warren Buffett was being mocked. His portfolio looked ancient. He didn't own the high-flying internet stocks. He didn't understand the new economy, people said. He was finished. Yesterday's news? An old man who'd missed the future. Berkshire stock fell while tech stock soared, and through it all, Buffett held significant cash positions and refused to overpay for businesses just because everyone else was doing it. Then came 2000, 2001, 2002. The bubble burst, fortunes evaporated, companies that were worth billions became worth nothing, and Warren Buffett, sitting on his cash, started buying, not frantically, not desperately, methodically, patiently, the way he always does. He waited until prices made sense, and then he acted. This pattern has repeated throughout his entire career. Hold cash when nothing is attractive. Wait without apology. Ignore the criticism. And when opportunity arrives, be ready. It sounds simple. It is simple, but simple and easy are not the same thing. For a retiree, this philosophy translates into something deeply practical. You're not trying to time the market. You're not trying to buy at the bottom and sell at the top. You're trying to build a financial life that doesn't require you to make perfect decisions during imperfect times. And cash is the foundation of that life. Here's where it gets emotionally complicated. You turn on the television and someone is shouting about how cash is trash. Inflation is running at 4%, 5%, maybe more, and your cash is earning 2% in the money market. You're losing purchasing power every single day. This is mathematically true, and it gnaws at you. Shouldn't you be doing something? Shouldn't you be in the market, earning returns, fighting inflation? Maybe, but maybe not. Because here's what that analysis misses. What's the cost of not having cash when you need it? What's the emotional cost of watching your portfolio drop 30% when you're 72 years old and drawing income from it? What's the cost of selling stocks in a panic because you didn't have a cash buffer and the furnace broke and the medical bill came and life happened the way life always does? Warren Buffett would tell you in his plain Nebraska way that losing 2% a year to inflation on your cash reserves is not your biggest risk. Your biggest risk is doing something stupid when you're scared. Your biggest risk is being forced to sell assets at the wrong time. Your biggest risk is running out of money, not because the market went down, but because you panicked when it did. Cash is emotional insurance. That's a phrase worth holding on to. Cash is what keeps you rational when the market is not. And rationality in retirement is worth far more than an extra percentage point or two of return. Let's talk about how much cash Buffett himself actually recommends for regular people, because this is where the headlines get messy. There's no official Buffett 30% cash rule for retirees. That's not how he thinks or talks. What he has said repeatedly and consistently is that most people should keep emergency reserves in cash, should avoid debt, and should invest the rest in low-cost index funds if they don't have the skill or temperament to pick stocks. But here's what's fascinating. While Buffett tells regular investors to stay fully invested in index funds over the long term, his own behavior at Berkshire shows something different. He holds massive cash positions. He walks away from deals. He waits years, sometimes decades, for the right opportunity. Does that make him a hypocrite? No, it makes him honest about the difference between managing a business and managing a retirement account. For Berkshire, cash is waiting capital. It's ammunition. Buffett is running a permanent conglomerate that can make billion-dollar acquisitions when others can't. That's a different game than retirement planning. But the principle underneath translates beautifully. Don't invest money you might need soon, and don't let anyone pressure you into taking risks that will keep you awake at night. So how much cash should a retiree actually hold? Here's the uncomfortable answer. It depends on you. It depends on your spending. It depends on your other income sources. It depends on your temperament and your health and your family situation and 1,000 other variables that no formula can capture. But here's a framework that makes sense, inspired by Buffett's principles, if not his exact words. Hold enough cash to cover at least 1 year of expenses, maybe 2, maybe 3, if it helps you sleep. The exact number isn't as important as the purpose. This cash isn't invested. It's not trying to earn returns. It exists to let you ignore short-term market chaos. It exists so you never have to sell stocks when they're down just to pay your bills. Beyond that emergency cushion, you might keep another allocation in short-term bonds or treasury bills, things that are safe and liquid but earn a bit more than cash. Then, and only then, you invest the rest in stocks or other growth assets, accepting that this portion might fluctuate wildly, but you won't need to touch it for years. This creates layers. Cash for immediate needs, bonds for intermediate needs, stocks for long-term growth. Each layer has a purpose. Each layer protects the others, and the whole structure is designed around one central idea. You will never be forced to sell at the wrong time. Warren Buffett built his fortune on companies, not market timing. He bought businesses he understood at prices that made sense, and he held them forever when possible. But undergirding all of that was cash management. He always kept enough liquidity to act, to survive, to thrive when others couldn't. Berkshire never became a forced seller. Even during the 2008 financial crisis, when the world was melting down, Berkshire had the cash to make deals, to help companies that desperately needed capital, to profit from chaos instead of succumbing to it. You're not running Berkshire Hathaway, but you're running your own life, and the same principle applies. Never put yourself in a position where you have to sell at a bad time. Structure your finances so that market volatility is something that happens to other people's stress levels, not yours. Here's a story that captures this perfectly. In 2008, When Bear Stearns collapsed and Lehman Brothers followed and the entire financial system seemed on the verge of implosion, Warren Buffett got a phone call. Goldman Sachs needed capital desperately. So did General Electric. These were American institutions, giants of industry and finance, and they were facing existential crisis. Buffett had cash. He could act. He made deals that earned Berkshire billions in the years that followed, not through genius market timing, but through simple preparation. He had capital when others didn't. He could buy when others had to sell. Now imagine being 70 years old in 2008 with no cash buffer. Your portfolio is down 40%. You need $20,000 for the year's expenses. You have to sell stocks at depressed prices just to eat, just to keep the lights on. That's the nightmare scenario, and it's exactly what cash prevents. The emotional weight of this cannot be overstated. Retirement isn't just about having enough money. It's about having enough peace. It's about structuring your financial life so that you can actually enjoy these years instead of checking your portfolio balance every morning with a knot in your stomach. Warren Buffett talks often about the importance of sleeping well. He's joked that he could make more money with more leverage, more risk, more complexity, but he doesn't want to. He wants to sleep well. He wants to know that Berkshire will survive anything. He wants certainty, not maximum returns. You deserve the same thing. You've earned it after 40 years of work, after decades of saving and sacrificing and building a nest egg. You deserve a financial structure that lets you sleep. And for most retirees, that means holding more cash than the optimal portfolio theory suggests. Because optimal on paper and optimal for your nervous system are two different calculations. Let's address the inflation worry directly, because it's real and it's legitimate. Cash loses purchasing power over time. That's a fact. If you hold 50% of your portfolio in cash and inflation runs at 4% annually, you're watching that cash shrink in real terms. Over 10 years, it's significant erosion. Over 20 years, it's devastating. So how do you reconcile the need for cash with the reality of inflation? Here's how Buffett would think about it. You hold cash for what it's meant to do, which is provide safety and optionality. You don't hold all your money in cash. You hold enough to serve its purpose, and you invest the rest in assets that can grow over time. The cash isn't trying to beat inflation. The cash is trying to keep you rational and solvent during the times when nothing else can. Your stock portfolio over 10 or 20 years should grow faster than inflation. Your bonds might roughly keep pace. Your cash will lose to inflation, but it wasn't trying to win that race. It was trying to win a different race, the race between fear and patience when markets crash. This is why asset allocation matters so much more in retirement than it did during accumulation. When you were 35, you could be 100% stocks and ride out any storm because time was on your side. When you're 65, 70, 75, time is still on your side. You might live another 30 years, but access to your money changes everything. You can't wait 10 years for recovery if you need income now. So you build in buffers. You build in safety. You accept slightly lower returns in exchange for significantly lower stress. Warren Buffett's favorite holding period is forever. But even he knows that forever requires survival first. You can't hold forever if you're forced to sell today. Cash is what keeps forever possible. Let's talk about the psychological game, because that's where most retirees lose. Not to bad investments, not to market crashes, to their own fear and greed and impatience. You watch your neighbor brag about his returns. You read about people retiring early with massive stock portfolios. You hear about Bitcoin millionaires and tech stock windfalls. And quietly, insidiously, you start to feel like you're missing out, like you're doing it wrong, like you should take more risk, chase more returns, be more aggressive. This is where cash saves you from yourself. When you have a solid cash position, when you know your next 2 years of expenses are secure, you can watch the market mania from a place of calm detachment. You don't need to chase. You don't need to prove anything. You can let the circus parade go by without joining it. Warren Buffett has lived through every mania of the last 70 years. He's seen the Nifty 50 bubble in the 1970s, the dot-com insanity of the late 1990s, the housing bubble of the 2000s, and whatever we're living through right now, and his response has always been the same. If it doesn't make sense, don't do it. If prices are crazy, wait. If everyone else is buying, maybe that's your signal to hold cash. This makes him seem boring. It makes him seem old-fashioned. It makes him seem like he's missing opportunities. But here's the thing about Warren Buffett that younger investors always forget. He's not trying to maximize excitement. He's trying to maximize long-term wealth and peace of mind. Those are different goals. For you, past 60, past the prime earning years, excitement is the last thing you need. You need predictability. You need safety. You need to know that your plan will work even if the market doesn't cooperate for a while. Cash gives you that. Cash is boring, and boring is beautiful when you're trying to make your money last 30 years. There's a Buffett quote that gets repeated endlessly but rarely understood. Be fearful when others are greedy, and greedy when others are fearful. On the surface, it sounds like market timing advice, but it's actually about emotional discipline and cash management. When everyone is greedy, when the market is soaring and people are borrowing to buy stocks, that's when you should be cautious, holding cash, waiting. When everyone is fearful, when panic is everywhere and stocks are being dumped, that's when you should be ready to act. But you can only act when you have cash. You can only buy when others are selling if you're not forced to sell too. This is the entire game. This is what Buffett has been doing for 70 years. And while you're not trying to beat the market or make billions, you can absolutely use this framework to protect yourself. Hold cash when things seem frothy. Use that cash when things get scary and you need it, or when opportunities appear that actually make sense. The hardest part, the part nobody talks about enough, is doing nothing. Warren Buffett is a master at doing nothing. He can go years without making a major acquisition. He can watch the market gyrate and hold his cash and refuse to participate in whatever trend is dominating headlines. This isn't laziness. It's discipline. It's knowing what he's waiting for and having the patience to wait. Retirees need this same skill. You need to be able to do nothing when nothing is the right move. You need to be able to hold your cash, ignore the noise, and trust your plan even when everyone around you seems to be getting richer faster. Because they're not. Usually, they're just taking more risk. And risk in retirement is a luxury you can't afford. Let's get practical for a moment. What does a cash-aware retirement portfolio actually look like? Not a recommendation, but an example based on principles Buffett would respect. Imagine you need $40,000 a year to live. You have Social Security covering half of that, so you need $20,000 from your portfolio. You might keep $60,000 in cash, 3 years of portfolio withdrawals. You keep another 100,000 or so in short-term bonds or CDs, laddered so something is maturing every few months. The rest, the bulk of your portfolio, is in stocks. Maybe a simple index fund, maybe a collection of solid dividend-paying companies. Whatever you're comfortable with. Now the market crashes 30%. Painful, but you don't panic. You draw your 20,000 from cash. Next year, same thing. Maybe year 3. By then, the market has probably recovered, at least partially. You sell some stocks to replenish your cash. You continue on. The crash was real. It hurt on paper, but it never touched your life because you had the buffer. That's the power of cash, not to make you rich, to keep you sane. Warren Buffett would add one more critical element: avoid debt. Never borrow in retirement. Never mortgage your security for a better return. Credit card debt, home equity loans, any form of leverage that puts your base of safety at risk, these are toxins in retirement. Cash is about staying liquid and flexible. Debt is the opposite. Debt is inflexibility. Debt is obligation. And obligation, when you're no longer earning a regular paycheck, is dangerous. Buffett has operated Berkshire with this principle forever. Yes, Berkshire has debt, but it's minimal relative to the size of the company, and it's always backed by mountains of cash and stable earnings. The company could pay off its debt tomorrow if needed. That's the position you want to be in. If you have any debt at all in retirement, you should have the cash to eliminate it whenever you choose. Never be trapped. Here's a deeper truth that Buffett embodies, but rarely states directly. Wealth is not about having the most money. Wealth is about having enough money that you never have to think about money. It's about reaching a point where the number doesn't matter anymore because the number is sufficient, and for retirees, cash accelerates that feeling. When you have cash, you have options. When you have options, you have freedom. And freedom is the entire point of financial planning. Think about Buffett himself. He's worth well over $100 billion, but he lives in the same modest house he bought in the 1950s. He eats at McDonald's. He drinks cherry Coke. He's not trying to impress anyone. He has more money than he could spend in 1,000 lifetimes, so money has become irrelevant to his daily existence. He's free. You don't need $100 billion to reach that same feeling. You just need enough, structured correctly. And part of enough is cash. Cash is what makes the difference between wealth on paper and wealth in your bones. You feel wealthy when you can handle whatever comes up without stress. That's the goal. As we move toward the end of this reflection, let's consider legacy and meaning, because that's where Buffett's thinking gets really interesting. He's pledged to give away 99% of his wealth. He's not building a dynasty. He's not trying to keep score. He's using his money to solve problems, to help people, to leave the world better than he found it. For retirees, legacy doesn't have to mean billions to charity. Legacy can be simpler. It can be financial stability for your spouse. It can be a grandchild's education. It can be the peace of knowing you won't burden your children. But to create any legacy, you first have to survive. You have to make your money last. And cash, boring cash, sitting in your account, earning minimal interest, is part of that survival. Warren Buffett once said that risk comes from not knowing what you're doing. In retirement, risk comes from not knowing what might happen. You don't know when the next recession will hit. You don't know when your car will die or your roof will leak or your health will fail. Cash is your answer to that uncertainty. It's preparation for the unknowable. There's something deeply peaceful about accepting this. You're not trying to predict the future. You're not trying to outsmart the market. You're just building enough redundancy into your financial life that the future can surprise you and you'll be fine. That's wisdom. That's the Buffett approach applied to ordinary life. As you sit with all of this, here's what matters most. Warren Buffett's real advice about cash isn't a percentage. It's a philosophy. Don't do stupid things. Don't take risks you can't afford. Keep enough liquidity that you're never forced into bad decisions. Invest the rest wisely and wait. That's it. That's the whole game. Should you hold 30% cash? Maybe. Should you hold 10% or 50%? Maybe. The number itself is less important than what the cash represents. Your commitment to staying rational, your refusal to panic, your acceptance that safety matters more than optimization. You've worked too long and too hard to gamble your security on squeezing out an extra point of return. You've earned the right to be boring. You've earned the right to hold cash and not apologize for it. You've earned the right to sleep well, to stop checking your portfolio every day, to trust that your plan is sound even when the market is chaos. Warren Buffett, at 94, sitting on record cash, isn't worried about what critics think. He knows his principles, he knows his philosophy, he knows that patience and discipline in cash have always been the foundation of lasting wealth. And he's willing to wait as long as it takes for opportunities that meet his standards. You can borrow that same patience. You can build that same foundation, not to become a billionaire, that ship has sailed, but to create something more valuable, a retirement where money serves you instead of the other way around, where cash in the bank means freedom in your life, where boring, stable, safe choices lead to extraordinary peace. That's the real lesson from Warren Buffett on cash in retirement. Not a formula, not a percentage, a way of thinking, a commitment to survival first, optimization second, a deep understanding that the greatest returns in life don't always show up on a brokerage statement. Hold enough cash to feel secure. Invest the rest in assets you understand, with patience you've earned. Ignore the noise, trust the process, and give yourself permission to be boring, because boring in retirement is another word for beautiful. Boring means you're going to be okay. And okay, after everything you've been through, after all you've built, is more than enough. Warren Buffett will keep holding his cash until something makes sense. You should do the same with yours. Not all of it, just enough. Enough to sleep, enough to wait, enough to never be forced into a decision you'll regret. The market will do what it does. Let it. You got cash in the bank and time on your side. That's more than enough.